Often, real estate investors believe that selling is the only exit strategy.
Moving forward with the Decker team. Moving forward together with the Decker team.
We are delighted that we are on episode 734 of Life's Inside Track, where you get insider tips, making house home, building wealth wisely, and you get free access to them. Go on over to our YouTube channel or check out chri.ca, and they're there for you every day.
Yes. And if you're wondering, how do I go to that channel? It's YouTube.com/DekkerTeam.com. Or no, sorry, YouTube.com/DekkerTeam.
Well, there you go. Selling often is the only strategy that real estate investors think they have when the numbers no longer work, or when they need access to some cash.
Yeah, and let's look at that. And sometimes exiting through the sale of a property is the right thing to do, even though there is a tax implication. Don't forget, like if we had a client once this year who decided they were going to sell a duplex because they're into the bigger multi-units, right? Where you can buy a bigger property, less down payment, but big, expensive ones. Well, you got to take some of that money from your duplex that you've made and move it over there. And yes, there's going to be some capital gains tax. But the nice thing is you paid it now and you won't have to pay it later on that money, right? Because you've already paid it. So when you sell the bigger one, you're going to have less capital gains tax on it because you already paid on the smaller one. Does that make sense? Yeah. And sometimes your portfolio or the way you look at investments, your strategy for your investments is changing. And sometimes you need to sell the odd piece to change what you're doing, because property management on a 18 unit, for instance, is marginally higher than property management on a duplex with two tenants, right? You still got to collect the rent. You still got to maintain the building. You got one building to maintain. It's just a little bit bigger.
Or a lot bigger.
Or a lot bigger. So sometimes strategy changes over time, and exiting is the right thing. Now, on the other thing we did with our 18 unit, speaking of 18 units, is we decided to refinance it and take the money that we put into it originally back out. So the property, now there's no tax implied there because we're removing the money that we put in initially.
That was already had taxes paid on it.
Right. So that money comes out. Now we can do whatever we want. We could pay, if we borrowed that money, say on a line of credit to buy that property, we could pay that line of credit off. Or we could take that money and say, okay, now we can buy another property and start multiplying. It depends on where you are in your life situation and where your lifestyle is going. If you're in the build stage, then you probably reinvest. If you're in the stage where you want to start rolling, just coasting a little bit, you may want to put that money, pay down debt, or you may want to invest it in something that's truly passive income, like top up your TFSA and put it in something that builds interest or that kind of thing.
Absolutely. Yeah. And sometimes the other flip side to this is sometimes there was a property that you purchased maybe for personal use, and then you moved from that house into another home and you kept it as an investment because you weren't ready to sell it. And at that point, the numbers worked and it wasn't a bad way to get started. It was low risk. It was easy for you to wrap your brain around that because you already knew the house. You weren't worried about what maintenance had to be done because you'd already maintained it well. So you hung on to it. And then you think you always have to hang on to it. Sometimes that property that was not, especially if it wasn't bought with the intent of investing, it was bought for personal use, maybe a really poor return on investment now because it's not a ideal property to be inside any investment portfolio.
It's underperforming compared to other properties that you may be able to purchase. Is that what you're saying?
Yeah, I'm saying it's so underperforming that it's almost like costing you rather than adding value to your strategy. So sometimes selling is the best approach. And really what we're going to say one more time is a clarity call will help you identify where your different investments might sit, because it may not be the same answer for all of them.
Yeah.
We got to look at them individually and how is each one of them performing, because you may look at it and go, well, overall, I got a great rate of return, except there's one or two sitting in there that's dragging the number down, even though at the end it's not a bad number.
Right.
What if every single one of them was pulling the number up?
Exactly. And, sometimes we look at someone's investment property and we analyze it and we go, okay, right now it's underperforming, but this property has potential.
Right.
We have potential to renovate, increase rents, and really increase the value. And so we're going to hold it with intention that we're going to do certain things, not hold it just because we're afraid or we don't want to pay capital gains. We're going to hold it because we know where it fits in our portfolio and what potential it has and what we're going to do in the future with it, right?
So exiting doesn't mean necessarily selling, and sometimes it does. It could mean refinance, with Ken suggested, and exiting from the current structure may mean hold. I mean, that sounds weird. I'm going to exit and I'm going to hold. Can you just expand on that? Because I think for people listening, they may say, you're talking crazy, people.
Well, it's still a future exit strategy. It just means not now.
Right.
And it means, what am I going to do with that property to increase its value so that later on I may exit either with refinancing or selling it, right? Because buy and hold is how you build wealth. But you got to hold wise investments. And if it's not a wise investment for you anymore, then we got to look at, how do we change it into a wise investment? How do we sell it? Or how do we refinance it?
Right. And then there's the whole conversation of flips, which this show is not about flips. And that's not really a wealth building strategy. That's a get access to some cash strategy. And the risks are a lot higher.
Yeah. And even an exit strategy where you go, oh, I've got too much equity in this property now. So it's not leveraged enough, or it's almost paid off, or it's paid off. That's the time to refinance it and take that money and buy another investment property with it. As long as you're buying another investment property, the interest on that money is still tax deductible against the income that you're receiving, right?
If some of this sounds confusing, really do go to DekkerTeam.com and schedule a clarity call, because whether it's your first investment or you already own 10, this is still, or more, this is still a great place to get some clarity that you may not have thought of all the potential opportunities to set yourself up for the right exit now or in the future.
Yeah. And, there's a stat out there that says 60% of investors will access their equity in their investment properties to re-leverage to buy another investment, right? So if your pressure was removed, what option do you think you would actually choose as far as repositioning your investments? Albert Einstein said,
in the middle of opportunity, or in the middle of difficulty, lies opportunity. I always want to get to that opportunity real quick. In the middle of difficulty lies opportunity. So there is difficulty around investment properties, and yet so many opportunities.
Right. And that brings us to the most misunderstood truth of all. Tax avoidance often costs us more than taxes themselves. We're glad that you're joining us, because as we bring clarity, your wisdom will flow.
Moving forward with the Decker team. Moving forward together with the